Welcome everyone, and thank you for joining McGill Young Alumni's second event of our financial literacy series. It will be on fundamentals of debt and credit management. I'm Camille, the VP membership of MYA, and I will be your moderator for today's event. As a brief introduction, MYA is a network that aims to connect alumni within 10 years of graduation to build a diverse and international network, one that can provide tools and opportunities for your personal and professional growth. With tax season, the recent boom of cryptocurrency, and the financial stress brought by the pandemic, we felt there was a need around providing financial access to financial knowledge in hopes of contributing to the financial health of our community members. Feel free to connect with us on our socials to submit topics, but also feedback and the topics you wish us to present next time. So this event focuses on debt and credit management and features key experts, Professor Amanda Abrams from McGill University and Frederic Delisle from BMO. Thank you both so much for joining us today. The speakers will share the floor for a total of 30 minutes before answering your questions for the next 30. Professor Abrams is a CPA, CA with over 15 years of experience in education, financial reporting, and auditing. She's the director of the CPA program at McGill Delisle Faculty of Management, and will focus on demystifying debt, its societal biases, and how to manage it. Frederic Delisle is an acclaimed director at BMO with a demonstrated history of working in the financial services industry. You worked in portfolio management, banking, credit analysis, commercial banking, you've done it all. So you will cover today the methods of getting credit, managing credit scores, and also how to approach investing in the real estate world. Without further ado, Professor Abrams, the floor is yours. Thank you.
Thank you very, very much. So I'm going to just share my screen and a brief presentation that I have for you. Make sure you guys see it there. So Thank you so much for having me today. Financial literacy has become a topic that I am so passionate about teaching and lecturing, and I was able to be part of the McGill Personal Finance Essentials course. So it's a free online course to anybody. I really recommend that you check it out, which would be great for you to have sort of a broad spectrum of all kinds of financial literacy topics. And just so that you know, when I teach accounting at the Delisle Faculty of Management, and you would be surprised that even my CPA students and my intermediate and advanced level accounting students and finance students still struggle when it comes to managing and even understanding their personal finances. This is a topic that is relevant to everybody and anybody. And especially when it comes to debt and credit, it's an important one. So what we see here is two sort of diverging attitudes when it comes to debt. And I'll admit it's a little bit extreme. It's a little bit of a generalization. But we have the first end of the spectrum where we have people that feel like, oh my God, debt and credit, avoid it at all costs. This is how you go bankrupt. I don't want to borrow even $1. And then you have the complete other end of the spectrum, which is great. Someone's offering me money now. I'll buy it now. I'll worry about it later. And you know, like I said, these are two sort of extreme mentalities. In reality, we all probably fit somewhere in the middle of this spectrum. And the things that influence these attitudes, mentality, it is very, it is very heavily influenced on our societal norms, influences, biases, things that we see on social media, and a lot of it really starts at home. It starts with the values and the lessons that we're taught when we're younger, that we see from our parents, from our friends around us, and things like that. So to give you a little bit of context, I'm a, as Camille said, I'm a CPA. I've been living independently financially for probably 15 years. I own a home, I have 2 children, and I still get cryptic phone calls from my father in the middle of the night saying, do you have any money sitting on your credit card? So, if that gives you a bit of an insight as to what my household was growing up and the attitudes that my father had towards debt, that's where I get a lot of my habits from. And in reality, to say today in 2021 that we are going to live debt-free, it's probably not realistic. It's probably not realistic, and it's not necessary either. But what is necessary to have is a good set of what I call debt and credit basics. Okay, before getting into the nuts and bolts and the details of it, you have to have some basics that you feel comfortable with before you start to borrow money and things like that. So I have it outlined, and this is what I try to teach my children. It's never too early to start talking about this. I have a 6-year-old and an 8-year-old, and we talk about this at every opportunity that we can, and we make it relevant and understandable to them, which is 3 steps. Easy peasy lemon squeezy. Step 1, you need to have a reasonable attitude when it comes to borrowing money, when it comes to debt and credit. So what do I mean by a reasonable attitude? I think my father's attitude is less reasonable today, given the fact that you need to borrow money sometimes, okay? So you need to accept that it can be part of everyday life, and it can be good for everyday life. But you also need to know, do I have a good budget in place? And am I respecting it? Am I living within my means? It's great that I see things on Instagram and Facebook and people living a life that might be real or not, but am I living within my means? If I need to borrow, do I need to buy? That's what I ask myself all the time. After step 1, once I've ensured that I have this reasonable attitude, I've said, okay, I'm gonna borrow money. Now, what are the options that are available to me? First of all, who's willing to lend me money? And how much is it going to cost me? Is it more beneficial to borrow from one type of credit institution or another? Should I be using a credit card? Should I be using a line of credit, right? Things like that. What are the options that are available to me, and what is the true cost of borrowing going to be? And then the last step, which is equally, if not more important, what's my plan? If I'm going to borrow money, how and when am I going to repay it? And I don't mean a general, yeah, I'll get around to repaying it. I mean specifically, is it going to be biweekly payments? Is it coming off of my paycheck? Is it how and when am I going to repay this debt? And once you have these 3 steps, it makes borrowing money a normal part of your life. Okay, so if I look at a few examples here, okay, if I look at the avocado toast and the gourmet coffee, now while I enjoy these things just as much as the next millennial, I'll be honest, okay, am I willing to borrow money to live that lifestyle, to enjoy those luxuries? I consider them luxuries for myself. Again, this is all personal. Right? For me, if I don't have that disposable income available to me in my spending account, I'm not going to put money on a credit card and let it sit there so that I could have a $7 coffee. If I move towards the middle column, right, and I look at things like education, travel. Now, depending on where you're from or where you live, these are things that could be really, really costly, and that might require you to borrow money, right? So I'll give you an example. If you live in Europe, then to travel around the continent, right, it's much more cost effective, if you will, than it is even to travel from Montreal to Toronto in an airplane. And it's a little less relevant since COVID. We've all sort of saved on that budget, but you know what I'm saying. And at the same time, if you live in Montreal and you're born in Montreal, well, then university might be something that's a lot more cost effective than if you were from out of province or things like that. And when it gets to these experiences that are going to have long-lasting, intangible benefits, not only today, but for the rest of your life, then you start to think more carefully and more seriously about borrowing in order to enjoy these types of experiences. And then when you move over to the last column and you look at things like vehicles and furniture and things like that, then we start to get into very expensive purchases that most likely most of us will have to borrow in some way, shape, or form in order to enjoy. Now, again, don't get me wrong, I love a good marketplace purchase for a mirror or a coffee table. But when it comes to buying a bed or furnishing a house or things like that, then you start to really consider what types of credit are available to you and how you can use that in order to maximize from the lowest fees and things like that. So what are some things that I want you to consider? And again, they're very basic in general, but the first thing to consider is, well, first of all, what are the availability of the funds? Is someone willing to lend me money? If I go into buy my car or finance my car or lease my car, are they willing to lend me the money to do this, right? If I want to open up a line of credit, am I able to do that? So how available are these funds to me? The second thing to consider is, what are the fees? What are the interest rates? This is going to represent the cost of borrowing for you, right? It's great to say, oh, I'll put it on a credit card and I'll worry about it later, but there's a cost to doing that, right? The interest and the fees that you spend, right? It helps to, you know, make financial institutions very profitable. So these are real costs of borrowing, and it's important to understand them, right? When you open up a credit card and they give you a 20-page document, how many of you actually read that? Right? When you want to download an application, you scroll to the bottom very quickly and you click, I accept. Did you read what you accepted? Right? In that document is going to outline all of the fees, the penalties, the costs, how the interest rate accumulates, how you're charged. That is really important to understand. Another thing to consider is how convenient it is to use it, right? So a credit card, for example, is very convenient, especially during COVID. How many of us have been making online purchases? It's linked to our smartphone, it's contactless payment, things like that. So that's something else that you want to consider when you're borrowing money. And then there's some other benefits that might be attached to, right, certain debt or credit facilities that you'll want to understand or take into consideration. Let's say if we look at three general options, and go over them high level, right? The first thing, and I love to talk about student loans, is because a lot of students don't even realize that you have these loans available to you. Now, I know I'm speaking to the Alumni Association, right? But some of you may have children, some of you may be pursuing education still. And so while you're a student, there are all kinds of benefits that are available to you. And student loans are one of them. Right? What's some of the positives about these, these credit facilities is that while you're studying, oftentimes it's either an interest-free loan or very low interest-bearing loan. So it's something that's interesting that you could take advantage of while you're a student, and then once you begin working and you're able to pay it back, again, you need a good plan to pay it back, right? You would only start to pay interest at that point, right? The drawback being these loans are usually only available to students. So if I look at, let's say, two of the more, the more common forms of borrowing, let's look at credit cards and lines of credit. Okay, and don't be shy if you've never heard of a line of credit, or if you're not really sure about what the difference is. A lot of my students, like I said, are not even sure what a line of credit is. So I'll start with a credit card. Typically, these are, some of the debt instruments that are easier to access, right? Because as your first credit card, you can be granted a very low credit limit, $500, $1,000. What's great about credit cards is that they're almost universally accepted as a method of payment. You can use them all over the world, use them online, link them to your smartphone, things like that. What's interesting about a credit card is that when you make purchases using a credit card, there's usually a very short, but a short interest-free period. So what people don't necessarily know is that if you make a purchase on your credit card and you pay it off almost right away or a few days later or within the interest-free grace period, it doesn't actually cost you anything to use your credit card. And we'll do an example on the next slide about that. And then there's some other potential benefits. So depending on the credit card that you have, right, you can accumulate loyalty points, cashback rewards. I used to book all of my trips on my credit card because it came with travel insurance, luggage insurance, things like that. So then all of that is outlined in that 20-page document that you don't read. And there's great resources on the Canadian government's website where you can compare every credit card out there. You can compare the fees, the interest rates, all of the benefits that are come with it, whether there's an annual fee attached with the card. One of the bigger drawbacks of credit cards is that it has the highest interest rate on an annual basis, right? So credit cards usually range in the 20 to 25% interest range, right? Which means that if you let money sit on a credit card and you don't repay it, it can be quite costly in terms of the interest that you're going to pay. A line of credit is something different. So again, not everybody is granted a line of credit. But once you've started to establish that you have, credit-worthy behaviors, that you're a credit-worthy individual, then financial institutions, depending on what other types of accounts and products that you have with them, right, they offer things called a line of credit, which is essentially like a borrowing room, a cushion, if you will, right? Where if you need to borrow on a line of credit up until a specified amount, then you have that room available to you. If you don't borrow on it, then you don't pay any interest. It's there for you when you need it. And so what's good about that is that generally these lines of credit have lower annual interest rates than credit cards do. They work a little bit differently. They're tied to something called a variable prime rate, all right? But they're generally lower than credit cards. They start to accumulate interest immediately, but when we do our example in the next slide, I'll explain to you how I use my line of credit, okay? The drawback being you can't really use a line of credit to pay for something online, and not everybody is granted one. But if if we just look at these three options, we already see that there's, depending on what our purchase is, what stage of our life we're at, and what we're looking to do with it, we already have options to evaluate. If we go back to the example of the car and the sofa. So those are retail purchases that you're making that are high dollar amounts, right? And it's very rare that you can walk into a car dealership and sort of drop the few thousands of dollars necessary for the car. So retailers will, depending on what type of retailer they are, will often offer their own financing solution. Right, so if you've ever walked into the Brick, let's say, and you go and you look at a couch, you can either pay it up front with a bag of cash, which people don't usually do. You can put it on a credit card, you can put it on your line of credit, or the store themselves will often offer you these financing solutions where they say, pay it over 24 months, don't pay any interest, or pay very, very low interest. And that's something interesting to consider as well. But the drawback of that, and what I want you to understand, is when you're doing things like that, if you're leasing a car or financing a car, or you're paying a couch off in 24 months, you are borrowing money. And so when or if you ever don't make a monthly payment, then there's a lot of fees and interest rates that are charged at that point. And the other thing to consider is going back to my step one, which was your budget, your reasonable attitude. If I walked into a furniture store and I had $1,000 in my pocket, I would know that I'm not spending more than $1,000 on my couch. But if I was offered the option to pay nothing now and pay $50 a month for the next 3 years, that sounds interesting to me. And that's something I might want to consider. But what's dangerous about that is that I've actually ended up spending more on my couch than I initially wanted to, right? So you have to really be diligent about planning out bigger purchases and things like that. If I take another example of $1,000, so I'll tell you how I manage my short-term borrowings. If I make all of my purchases on my credit card. The reason I do this, I don't tell my father because I think it would keep him up at night. But the reason I do this is because I get cashback rewards and I get other benefits from my credit card. But what I also do is every single week I go and I pay my credit card off in full. I don't ever carry a balance on my credit card because when I make a purchase on my credit card, if I pay it off right away, I don't pay any interest on that. At the end of the month, you'll get your credit card bill. And what's really important to understand is when you get a credit card bill, it will tell you the minimum amount you need to pay, and it will tell you your full balance. If you only pay your minimum balance, then what happens is everything else that's remaining on your credit card, then it starts to accumulate interest. And it starts to accumulate interest going back from the day that you purchased it. So then you're paying that 20% annual rate, right, on these purchases that are remaining on your credit card. So at the end of the month, if I were to have $1,000 left in a credit card balance that I couldn't pay off right now, what I would then do is I would transfer that balance to my line of credit, and I would be immediately accruing interest on my line of credit, but my line of credit bears something closer to 7 or 8% interest, not 20%. So that's how I manage my debt and credit. And there's ways that you guys can do this. You just have to ask questions. You just have to try to understand the way that the mechanics work a little bit. And the reason I say that, you know, it's not realistic to live completely debt-free is because you want to establish that you're a credit-worthy person, right? The more that you use debt responsibly and reasonably, the more that you pay it back on time, and the more that you don't, you know, incur any costs or things like, fees and penalties and things like that. What you're doing is you're building up good credit, right? You're building up towards your credit score and your credit report as an excellent candidate or a good candidate to borrow money. Think of going and asking your parents to borrow their car when you were younger, right? You want to borrow your parents' car and you want to drive across Canada with it. Now, if you've never used their car before, it's unlikely that they're going to say, sure, have fun, you know, text me when you get there, right? But if, for instance, I'll give you an example, you've been using their car every week for a year. You've returned it in excellent condition. It's always been clean with a full tank of gas, no damage, and you've given it the periodic car wash, right? Then the odds of them granting you access to their car when you want to take it for a bigger stake investment are a lot higher than if you've never established yourself as a worthy, credit-worthy person or individual. Now, if you take the car and you crash it, that's also going to stay on your credit report, right? So think of your credit score and your credit report as a report card for life. As you start to borrow money, as you start to use it responsibly, you're building up a good, you know, report card for yourself. And inevitably, like I said, in 2021, in a Canadian real estate market, if you ever want to buy a home or a property, this is probably the one purchase that will universally unite us in having to borrow money. Now, of course, we're not going to put our home on a credit card. We're going to use a much more sophisticated, much more tailored debt instrument called a mortgage. And Frederic is going to speak to you about that in a lot more detail than I will. But you see, when it comes to needing to borrow money, it's always good to have established a good credit history so that if you ever do need to borrow money, then it's available to you and it's available at a reasonable or, you know, better rate or price or things like that. So I think this is a good segue to end my presentation and to introduce Frederic to speak to you a little bit more in detail about this. And again, I just wanted to thank you so much for having me. It's really something that I love to do.
Thank you. Thank you, Professor Abrams. I'll take it from here. Great things you just said. One of the things I maybe wanted to add was credit cards. When you do a purchase with a credit card, people don't know that, but these purchases are insured for up to 12 months normally. So I had a situation where I bought groceries and my fridge broke down, and I was able to get actually the grocery insured and the money back in my account to purchase them again because they were all spoiled within a day. So a lot of things that you can do with credit cards as well. I did crash my mom's car once, but that's neither here nor there. She still loves me, I think. All right, so thank you very much for this this opportunity to talk to you, and we'll look more into the details of how banks will look at your situation, your credits, and how we look at things. Like I said, I've been a banker for well, tomorrow is going to be my 20th year at Bank of Montreal. So it's been a while, and I've done a little bit of everything, and been in credit most of my banking life. If you look at our presentation and looking at your credit and how banks look at your credit as a whole, here are the 5 C's of credit. Very easily, we look at character, capacity, credit, capital, and collateral. If we go one by one, and I'll start with characters, the character of an individual, we're going to look at their saving habits and their spending habits. So do they have pending debt on credit cards, on lines of credits? do they save money? Do they have any money in their RRSPs? Do they have a savings account? What is their current short-term capacity to pay their debts? Employment stability is part of character. So somebody that flips flops between jobs, of course, when you're younger, it's expected. But if you're 40-year-old or older than that, the field and the time on your job shows stability and increases your score on that front. Now, addressability is also something. So if you live in Montreal, you've always been living in Montreal, it's one other criteria, not as important as many others, but it's something that we would look at. Now, capacity is also very, very important when you look at things, and it's basically your revenue. So what you have as a revenue versus your current and future debt. So if we're adding debt to your current situation, we're going to calculate that as well. So it's always a percentage of your revenue, and we often take gross revenue, and 40% would be a good rule of thumb. So 40% of your current revenue. If we surpass 40% of your gross revenue, not net revenue, but gross revenue, often it's harder to get credit. Now, credit, and it's mostly about credit history. So a little bit like Professor Abrams was saying, your credit score. And your credit score is derived from, are you making your payments on time? Did you have any bad debt? How much are you using your revolving credit? And by revolving credit, I mean lines of credit and credit cards. So are you using them to 80%, 70%, or only 20%? Very important to know that. How many recent applications you do will impact your credit score. But of course, it needs a lot of application to really reduce your credit score. Your credit score is and what we call also beacon score, is 900 points. And basically your points will fluctuate depending on how you're using your credit and also how many applications you're doing. Of course, we're expecting if somebody makes 15 applications during a span of 5 days, it's often wrong. But if he's doing it for the same purpose, it's not going to affect their credit score as much as if it would be for a credit card and it's always refused. That's important to know as well. Now, capital, very easy concept. What are your assets? And by assets, I mean the balances in your bank accounts, investments that you have, and also the equity that you have on your home. That's basically your main assets versus the debts that you have. So currently the balances that you're carrying on your mortgage, on your lines of credit, on your credit cards, on your car loan, all of that are debts. Now, if I want to go back to assets, a car is a depreciative asset. So basically, as soon as you take it out of the dealership, it loses about 30% of its value. So your loan might be higher than the actual value of the car to us. That's a depreciation. And this asset will continue to go down in value as time goes on. Now, it's important to understand this fact as well. Down payment source, so capital. So if you're purchasing a bigger asset like a home, we will ask for a down payment. Or a car might require a down payment to get better interest rate, by the way. Now, a down payment, what is the source of the down payment is very important. Is it somebody else that gave it to you, like your parents, like an aunt and uncle? Did you receive it from I don't know, an inheritance? Or did you build that down payment yourself by saving money? So that also is part of what is your character as somebody that looks for credit right now. And how liquid are your assets? So investment savings accounts, very, very liquid. Of course, if it's an RRSP, it's less liquid than somebody that's not locked in, but still, money is always king. Collateral. So what I have in guarantee to provide you with a proper rate, a proper loan for what you're asking me. So collateral for a mortgage is the house itself, right? So this is an asset that normally will gain value in time if the upkeep is done properly. So that's a good collateral. Like a car is a collateral that will give you a better interest rate when you're at the dealership than if you just ask for a personal loan. Like a car loan right now, even for a used car, I've seen rates around 6 and 7% right now. If you ask for just a personal loan for any purpose, it's mostly around 10, 11, 12%. So there's a difference there. Now, first-time home buyers, it's a very, very apropos subject right now. The market is overheating to some extent, and first-time home buyers will often not have the 20% required to purchase their first home. Of course, this makes them having to have an default insured mortgage, which different company, but also government agencies like the CMHC that will provide insurance to bank on default of this loan. So that will permit a first home buyer to put down 5% instead of the regular 20% required to purchase a home. I've put an example up to the right of your screen here. And if you look at a purchase price of $400,000, the down payment required would be $20,000. So that's 5% of $400,000. That's the middle of your screen. The amortization over 25 years and a mortgage rate of 3%. That makes a payment of $1,870 per month. Now, if you look at your mortgage costs, like given the fact that you didn't give 20% down, there's an insurance cost to that. So the insurance cost, the premium of this insurance is 4% of the landed value of the property. So basically, if the purchase price is $400, 4% insurance is $15,200. That's the cost of your insurance. What we do is if you take your purchase price of $400 minus your down payment, normally your mortgage would be $380, but we tack on the mortgage insurance premium to your mortgage amount, which would make your mortgage amount $395,200 in this case. Now, of course, that $15,000 being tacked onto your mortgage, you're paying interest over it as well. So that's important to understand. Your premium is not just $15,200 unless you have the money to pay it right away. And you can do that, but normally people will add it on to their mortgage amount. Now, the bottom part of it, you can see how much $15,200 would cost you over 25 years at 3%. So if the mortgage stays at 3% for 25 years, that $15,200 would have cost you an extra $6,376 just in interest. So now your premium it has cost you $21,000 or a little $21,500 over the life of your mortgage, which is, when we think about it, it's actually more than the down payment you just put on the house. Important fact also to know that in Quebec, insurance premiums are taxable, 9%. So when you go to notary, the notary will ask you to pay the taxes on that premium, not the bank. So that's sometimes you don't know about it. You get to the notary, and on top of the notary fees, which is around $1,300 right now, you'll get a premium to pay for the insurance premium that you have on your mortgage, which will be 9% here in Quebec, so around $1,500 extra. Of course, very important to, when you have a debt, to have most important thing is to have an asset that's connected to it most of the time. I think we were brought up a little bit the same way me and Professor Abrams were carrying balances on lines of credits and definitely credit cards is very frowned upon. But investing in the future, being buying your first home, your second home, a vacation home, refinancing your house to do renovation, to have an asset that has more value, is also a good investment in the end, because you always have an asset that's attached to it. Of course, a lot of people right now are refinancing their homes, and refinance is up to 80% to purchase, to take that equity out of their home, to purchase investment properties, and have that investment property, the rental income from that property, pay down that debt. And of course, given the fact that properties have gained value in the future, in the last 20 years, this has been a lot of people have been doing that and been very, very successful with it. What's important to understand is that you also have a lot of costs associated to home ownership or investment property ownership. There's always the upkeep, keeping everything in good order, and also not having the value of the property depreciate by not doing the right amount of work on the house to just upkeep it. Of course, there's also city taxes involved, and costs. The interest cost of having this property is on an investment property would be deductible, but in the end, very important to understand that when you have a debt and an asset against it, it's always preferable. And investment properties, of course, would be interesting. Vacation home, it's more for a personal use and you don't get revenue from that, but investment property with the rental income could potentially be a great venue to invest your money. That would be it for me. Thank you very much for the time, and I think we're going to go into a Q&A. Camille, you can take back the control.
Thank you very much, Frederic. I'm trying to put on my camera. I'm back now. I'm just waiting for Professor. Thank you. Abrams, Professor Abrams just joined us. So thank you both for your amazing presentation. It was extremely insightful. We've got a lot of questions that I've tried to categorize in 3 different categories to help. So just because your presentation was extremely detailed, Frederic, before going more into the broader question, I would like to already ask those very technical questions, as the numbers are still fresh in our minds. So there was a question about, is the 4% premium for insurance when paying less than 20% is the same for all age group, or will differ based on your age or maybe the bank that you approach?
It is not something that moves with age or your group age or anything else. It is what it is. The only thing it moves to is the down payment. So if your down payment would be 10%, then it would be less. If it's 15%, then it would be less. But it's just the money. Nothing else impacts.
Nothing else. Okay, very good to know. Maybe still on that line of real estate, which is the third category that I had, but let's dive into it a bit more. Is it worth investing in a house when the interests are cheap, like today, but you don't necessarily have a big amount of down payment to put, like for example, the 20% that is usually recommended?
Yeah, that's a very personal question in the end, right? It's also important to know that people take a lot of debt on early without having the right down payment and the fallback position. The fallback position is so important to have that line of credit not used. Like maybe I'll have a repair, maybe I'll have to buy an extra couch because I have more space. And again, it's tough to say right now with the prices going up. Let's say you have a house that's worth, you want to buy a condo, it's $300,000. And the markets being what they are right now, if you were trying to buy that condo a year ago, that condo has gone up 22%. So basically it's worth 300, the purchase price now is 360. So if you had a down payment of $60,000, you don't have enough money to buy it outright without an insurer. at this point, right?
Mm-hmm.
So it's hard to say. It's really a personal question. I think the market right now, in terms of housing market, has been going so fast
Mm-hmm.
that it's might be good to get in right away if you have the
Mm-hmm.
right resources. Every market has a cycle. We've been on the market for 22 years straight in terms of real estate here in Montreal and in Quebec. So at some point, it might go down. I don't know how, when. If I were, I would be a very rich man, but we don't know. And a lot of people invest 100%, like they're financing their down payment basically, and they're leveraging 100% of that asset, and basically trying to say like this property will never lose value ever. It will always gain some. I'll be able to gain equity by the payments that I make and the value of the house increasing. But if the house go down, the price, you might have more debt, and we've seen it with the subprime crisis in the U.S. Mortgages, you had a $500,000 mortgage on a $400,000 house, so you were at minus $100,000. So it's important that this can happen here in Canada as well.
And maybe based on those personal habits, is there something, Mr. Abrams, that you would like to bring as well when coming into the real estate market? Maybe some habits to make sure that you have and prepared, maybe not using a credit line to finance a down payment or something like this.
I think that you just said it. It's such a personal choice. So for instance, I was faced with that dilemma when I owned a condo, downtown Montreal, and when I made the decision to move to the suburbs and buy a house, I had that exact dilemma. Do I keep it? Do I rent it? Where do I take my down payment from? So I think it comes down to the fact that Frederic was very, I think, cautious and very informative to make you consider as well that it's great when a market is on the up and up to think, oh, I got to get in and I'm going to capitalize on this, and without necessarily realizing, right, the opportunity cost of your money, right, where you're putting it in real estate versus something else. Also, if something were to break, be damaged, right, there's taxes, carrying costs, things like that. If you have a tenant that leaves and it is tenantless, that could be costly to carry as well. So I think that when it comes to real estate, right, it is a personal choice, and it comes down to also living within your means and thinking, if it's great to think of the best case scenario, but you have to consider, am I able to carry these costs without a tenant? For how long would I be able to carry these costs for? Would I be able to live in my own home and carry my investment property if I were to have it, I believe it's go dark, or right, if there was no income coming in. So, if you have a realistic and a good budget, it's something interesting to consider. And again, right, if you're doing it for investment purposes, it's a different conversation, right? Because then there's other investment options as well. So when you think of really the debt load of it, right, if I think of a mortgage, for me, it's always been a debt, because I've used a mortgage for my own personal living and borrowing scenario. If you're thinking about it from an investment perspective, then it's a different conversation as well. That's my opinion.
That's very, very interesting. Very good. I think that ties us. Oh, yes, sir.
If I can add something. So currently the rates are very low, historically low, and people think, well, basically I can borrow because it's 2% for a mortgage, right?
Exactly.
But when we qualify people, we have to qualify them at 4.79% on 25-year amortization. So whatever the budget you have, I'm still calculating the fact that the rates historically in Canada have been around 5. Well, there's years that have been 17, 18%, but 5. Basically, that's what I'm qualifying you on. And that way, there's a margin there. If the rates go up, people will still be able to afford their homes, which is super important for the market in general and the Canadian economy as a whole.
Yeah. Yeah, that's a very good point to bring up as well. I think not many people know that that you have an internal grading as well. So I think this ties us into a very interesting question about also habits, spending habits that Professor Abrams had brought up in her first slides. And so a lot of questions were about, so tied to credit scores, but so how do you balance paying back high debt and building consistent saving habits? For example, if you have a credit card debt, should you be saving on the side, or should you really focus on paying that debt? So I think
I could just add, I was having a conversation with a very esteemed finance professor, and he said, I always start my strategic investment class with a tip, a hot market tip, and the students are always ready to take it down with a pen and paper, and they say, okay, what? And he says, okay, do you want to know the best investment that's going to have the highest return immediately, what you could do? And they all said, yeah, what is it? They were ready to write it down. He said, if you have any money on your credit card, pay that off, right? If you have money sitting on your credit card from month to month to month, you just made yourself a 20% investment. So it's, again, right, there's things like mortgages, car loans, things like that, where on a long-term basis, right? Like Frederic said, the rates are very, very competitive, very low right now. If this is the type of debt and borrowing that you have, then it's really important to also think, okay, investments, RRSPs, TFSA, things like that as well. If you have $10,000 sitting on a credit card, in my opinion, the best investment you can make is to pay off that balance, to get that money off of a credit card. So, and that's really behavioral finance, right? Where you think, I need to put it in a TFSA, but I have money sitting on a credit card, right? So look at your short-term debts and whatever's paying a high interest rate, right? If you can minimize that or get that down to a zero balance, then I think it's beneficial to start looking at other typical investment vehicles. And Frederic, maybe you have something more specific to add to that, but
Well, you know what? Budget, again, budget. To me, what saved me to save, well, to save money, put money aside to purchase a home and pay down my cards is the same thing. And it's being in automatic payments and or automatic investment. The day my paycheck comes in, there's a portion of it that goes into a TFSA. There's a portion of it that goes into my RSPs. There's a that goes to like the day my credit card balance has to be paid, it's getting paid through my bank account. And if there's no money in my bank account, it gets a little bit like Professor Abrams, taken from my line of credit if there's no money there. Everything is automated. I just don't have to think about it. I'm a banker and I don't have time to do this thing. So come into a bank, any bank you choose, but go see your financial advisor and he can set that up for you and build with you. Like, take the time to do a budget. You will gain so much from it. And basically all these automatic saving plans, and that's what made me be able to purchase my first condo and then a house now. So that's totally how I save money. It's automated. That's the only reason I'm okay now.
No, it's a very interesting point. Usually we advised a little bit against automation, just because it kind of implied that maybe you're not very involved in your money, or you lose sight of it. So but it's good also to know your own weaknesses as a human, and that maybe sometimes you push to the side. So a robot can do that better for you. But I think you're both touching on a point that I'd be interested in knowing is, what is the biggest misconception about saving money? It seems like, well, automation is great, simplicity also, pay the highest rate, interest and debt that you have. Do you have any insight on, so yeah, what is the biggest misconception about money, saving money? Maybe Professor Abrams, you can start.
So I think, it's such a good question to be asking right now after being in a lockdown for a year, because, I think that some of us, it was a very difficult year, challenges, absolutely. And I think what it made us question as well, and it comes down to it, the top line, which is our spending habits, right? So you can't save money that you've already spent, right? And for instance, it starts, for me, I don't automate. I'm a dinosaur, if you will. I think I would use a pen and paper if I could. But I do have, right, that voice in my head saying, my father taught me very simply, he said, somebody who makes $1 million a year and spends $1 million in one is not richer than someone who makes $50,000 a year and spends 49, right? So it's such a simple concept. And for me, I really try to live by it. Spend less than I make. Spend less than I make. And when you do that, you feel richer. So, you know, and that's not to say go without, but it really is our spending habits that start off if we're able to save or not, right? And it's not the big purchases that get you. It's the little purchases. It's the $20 every day that adds up to much more than the $1,000 because it's easier to spend $20, right? Absolutely. And it's easier to put $20 on a credit card, but you think twice before you put $1,000 on a credit card. So to me, that's how I've managed to save. I really do start with my step one, which is, do I need it? If I have to borrow, do I need to buy? And sometimes the answer is yes. And then I make myself a plan to resave. And then, of course, whatever's left can be saved. But I think starting with a realistic mentality is a good step.
That's very good. Very good. Frederic?
Yeah. The 50-30-20 rule, and you can search online. I'm not the first one to say anything about this, but 50% is need, 30% is want. We're all humans. We want stuff. Don't get me wrong. And 20% savings. And if pretty much you adhere to that, you'll see things move the right way. And of course, there's months where 20% savings, yeah, it might be for a want in the other column, but it's still, if you're able to save for 6 months for a big purchase, you'll be better off putting it on a credit card and paying that high interest rate. To go back to your question, the biggest misconception about saving money, I would say that guaranteed investments are safe. They are in a sense, but in terms of buying power, probably are losing money in the end. So if the interest rates that I'm giving you is 1% currently on maybe a 1-year GIC, in a year from now, the inflation rate would have been probably 2%. So you're losing 1% in buying power during that 12 months. So you might have lost buying power. It's important to really look at everything as a whole. And if you have a long time horizon, yeah, of course, you can afford a little risk in the market. If you're really like risk averse, I'm not really a risky type of guy who invests in Bitcoins or whatever. I'm not that guy, but it's important to understand that if you don't have it, like let's say you're purchasing a home in 6 months, it might be tough to put it in your savings account instead of trying to write it in even mutual funds or ETFs, or just trying to gamble it away at a casino. Like, it's important for you to put it in a secure investment. That's fine. But if you have a long time horizon, guaranteed investments are not as safe as you want them to be sometimes.
Interesting. Because we have 6 minutes left on the clock, I would love to ask a question that were very specifically about credit scores, which are also heavily impacted by your spending habits and debt management. So why does looking, so it was a very general question, but why does looking at our credit score break down the credit score itself? And so what is your recommendation on this for those who wish to see their credit score maybe quite regularly in check? Maybe Frederic, if you want to start on this question.
Yeah, so it's important to use your credit well. It's important to pay it on time. Those are the two things that will impact your credit bureau the most. And then it's important that when you do an application for credit, that you don't do 10 of them at the same time, like that you don't repeat. And if you're refused for one, ask your bank why, and basically understand the whys and change your plan accordingly, because that is the most important thing. If you refuse for one, we all deal with MasterCards and Visas. If you apply for a credit card and it's refused, and then it's refused again at TD and CIBC and RBC, it doesn't look good on your credit. So this will impact your credit as well. But nowadays, most bank and have an app, right, to do your payments, to follow your accounts. Inside that app, we have your credit score live. If you want it, you click on a button, you see your credit score, and that is a great tool to follow. Like, you don't have to go to TransUnion or Equifax, which are the main credit score companies here in Canada. You can follow them on your app, and you can even test what is it going to do if I have a $10,000 credit card extra. Press on a button and see how much it will affect my credit score down or up. If I do one application, I tested it just before the call. If I do one credit application right now, my score goes down 1 point. It's not that much. But if I would do 5, it would go down 100 points.
Oh, okay. So exponential.
So, you know, if I do 5 within 10 days, that's how much it goes down. So it's important to understand all those factors, and there's nothing like following it. Yeah.
And maybe ask your financial advisor or like someone at the bank before those applications.
100%.
Okay, that's very good to know, especially about the app. I didn't know about this.
Yeah.
Professor Abrams, is there anything you would like to add to the question?
No, I think that was really great. I think that people don't know where to access this information. So, you know, quite frankly, I didn't know that I could access it on my app as well. And I'm going to go look at my banking app to see if I could see that as well. So I think that's the whole point, is people don't know necessarily where or who to ask the questions. So they don't, and then they remain mystified by all these topics. So when it's so user-friendly and so available to us, you know, you almost feel very encouraged to go ahead and get started. And, you know, and just while we're talking about apps, and because I don't know if Frederic wanted to be selling these points of these apps, but you can also download your transaction histories, and they have budgeting tools and things like that built into the apps as well. So all of that, you know, really understanding these things at our fingertips that are available to us is so helpful in terms of, you know, starting to plan for savings and credit.
Absolutely. You're bringing up an excellent question that was actually asked, and was in reaction to the government that you were mentioning, that we're comparing different credit cards. So what is the website specifically? And then is there any other public resources that access for bigger financial wealth of knowledge?
Yeah, so when I was developing my material for the McGill Personal Finance Essentials course, I really used the Government of Canada's website. You can look and you see there's a finance link to it, and it's all kinds of personal finance links. And so things like budgeting, mortgages, it's all explained at a basic high level. And then there is a link for credit cards specifically, and I could send that to you afterwards if you like, where they really look at all the various credit cards that are out there, and it has it for comparison purposes right away, all of the fees, interest rates, and things like that. So the government itself has great resources. When you just type into Google free personal finance resources, right, you'll see things pop up. Of course, I'm going to plug McGill's Personal Finance Essentials course. I think it's fantastic. I think it's a great starting point. And with your actual bank, and I guess Frederic could speak to that as well, like whatever banking institution you're doing your banking with, they have excellent resources as well. I think people assume that they're sort of biased and you know, and they maybe discount the accuracy of the information, but it's very good information, right? And usually to the benefit of the user. So I would encourage people to just look for those types of resources.
Very good.
Absolutely. There's nothing like just, and sometimes it's overwhelming. Yeah, the CMHC side, the Government of Canada side, great resources for information, but it might be overwhelming. There's too much of it. And there's nothing like just sitting with a financial planner, sitting with your investment advisor, and just looking over your situation, your situation, and assessing what needs to be done. We have everything. Your budget is an open book when you come in and see us, and we have access to your profile. We section that passes through your credit card and your account, and we can make a very, very super specific budget for you and
Mhm.
get you on the right path. And that's our goal. Like it's to build lasting relationship with our customers, because if we don't, well, we're out of business. That's it. That's how we have customers.
Perfect. So I see that it's 1 p.m. I have 3 questions left, but I want to be mindful of your time. Are you okay with going a little 5 minutes overboard?
Yeah, of course.
And then we'll wrap it up nicely. But so there was a specific personal question that I thought would be very interesting to have your insight on. And so the question was, how does being a long-time student impact your character and capacity of your credit score? So the person has been a student for a long time, has student debt, and doesn't make a lot of money as a TA, so a teacher assistant. And so how does that specific credit score? Frederic, you want to go first?
Yeah, I think in that space, it's more, how are you currently paying your debt, and are you living within your budget? So when it's time to do an application, what money have you saved? And if you haven't saved money, then let's build a plan to do so. But it's how did you manage your debt currently? And of course, like a lot of people have student debts and past their 30th, 35th. Even doctors, most doctors do, because their debt is quite a lot higher than mine when I got out of a finance degree. So it's not something that to be scared about, and definitely every plan is not the same. So it's important that all of these little factors that I was showing on my presentation are all factors. There's nothing that's not important in there, and basically the character of the individual, how they manage their money, is going to be the most important one in the end.
Perfect. Very good to know. Professor Abrams, is there anything you want to add, or should I move on to the next question?
Yeah, I just think that you shouldn't discount either. Like if you've been a student, but you have, for instance, a credit card, it's good to put small purchases on it and pay it off right away, right? So you don't need to have bought a car or bought a home to establish credit. So people don't realize that things like opening a credit card, putting $100 on it a month and paying it off every month starts to establish credit. So little steps that you could take to develop your character, your debt, your credit character, it goes a long way, particularly if you are a student and you're able to do things like that. So
that's very good. Actually, then more specifically, the line of credit, is there a time frame to repay the money from the line of credit so that it doesn't negatively affect your credit score? So a very technical question here. Do you want to start answering?
Yeah, so there's always a due date on lines of credit, a little bit like credit cards.
Okay.
But there's no grace period. So basically, day one, you're starting paying interest on a line of credit. That's it. It's very simple. It's once a month you need to pay. Sometimes personal lines of credits have interest-only payments options.
Okay.
There are people who will only pay the interest. That's not something that I would suggest you to do. Always try to pay down the capital. Have a plan to pay down that capital and stick to that plan. But the minimum payment, or normally what's in your credit bureau, is 3% of the balance of the loan. So that's the minimum payment on the credit bureau that shows. So if you have $1,000, 3% of that would be the minimum payment required, so $300.
Very good. And maybe as the last question, because I'm seeing we're really into 5 minutes. So studies have shown that women are more financially stressed than men, and it's largely due to the wage gap, notably, making it harder to save. But is there any advice you think is beneficial for and not shared enough to women when managing debt? And Professor Abrams, if you don't mind, can you start with this?
Sure. I think that again, I think that it's a great question to ask and say specifically, how does this affect women differently? And I think that what statistically has been shown is that women have a more difficult time asking questions and asserting themselves in general. So I think, for instance, in terms of asking for pay raises or asking for, you know, equality in terms of conditions, payment, things like that, women are statistically shown to be at a disadvantage. So I would say that don't feel like it's something that you can't ask the question or ask for. Again, I have a very strong voice in my head, which is my father's voice saying, you will never get what you don't ask for. You might not get everything you ask for, but if you don't ask, you'll never get it. So that's the first thing, is to not, you know, to assert yourself and ask for what it is that you deserve and you merit. And I also think that it's important to break down traditional roles of, you know, a lot of times I think that if I look at my circle of friends and peers, when you look at the division of tasks in a household or things like that, I don't know why, but traditionally money and finances seems to be usually taken on by a male counterpart if you have a male partner. And a lot of my female peers, oh, I don't know, I don't manage that. And so, you know, that also adds to the feeling of insecurity, and it actually adds to your ability to be an independent as well, right? Your self-esteem, your independence, anxiety, mental well-being, everything like that. So I would say that as a woman, it is especially important to take charge of your personal finances. You don't have to do everything yourselves. You can use financial advice, but to at least ask the questions and understand it, right? As if we're looking at it on an individual basis, I think is really, really important. And to not be afraid to ask the questions, right? You know, that's really what I would advise.
There is no wrong question, for sure.
Definitely.
Frederic, is there any point that you would like to add?
Well, I think this event, the financial literacy, starts very young. Like we're alumni, people that have full lives, but we start our kids by talking to them about budget. And when you go to the grocery store, something as simple as taking that can that costs 29 cents less, and showing them why and what impact does it have over time. They will get the right ideas and live a better life. And don't just do that with your son, do that with everybody, everyone, daughter as well. And I think we'll be in a much better place after that.
Very good. Well, again, thank you so much for your time. Both, thank you so much for your wealth of knowledge. It has been extremely insightful, and I'm sure very beneficial for the rest of our community members. So everyone will get a link to the recording in a separate email. And please don't forget to connect with us, MYA, on our socials, LinkedIn, Instagram, and Facebook. And finally, please share your feedback and keep an eye out for our last event of this 3-part series, which will be on insurance and will happen by the end of June. And finally, please remember that if you're graduating this semester, you automatically become a young alumni. So we hope to see you as well around next year. Well, thank you again. And please, everyone, have a great rest of your day. Goodbye.
Thank you. Thank you for having us.